Joining us now is David Burrows. He's the president of Barometer Capital. David, we were talking in the break. When you're looking at the market right now, what are you seeing? Let's go back to October 5th when we saw that bounce off the lows.
Yeah, it's really interesting. Certainly, you know, we felt when we undercut the lows at the beginning of October, held and rallied. In the work that we do, which looks at market breadth, we saw clear divergence between the lows in August and the lower lows in October, yet breadth was better. So that to us told us that we were into a fall fourth quarter rally. The first few days, of course, everything rallied, and lots of people jumped right back into those risk assets that they've made money in previous rallies. What becomes most important is once you get through that first lift and you get some consolidation like we've been having in the last 4 days, what is it that holds the gains? And what is it that gives it back? And I think it's really interesting, especially for the Canadian market, that so many of the basic materials and highly economically sensitive names are giving it back over the last few days. Yet the defensives like pharma, utilities, pipelines, telcos are holding gains and going on to new highs. And so there's a lot to be read from that, because this is where you start to see the leadership emerge in the market. And once we go through this consolidation, my guess is coming out over the next week or so we'll go higher. But this is the stuff probably that leads the market higher.
But in Toronto, those names that you mentioned aren't big enough weights, really, to get to lift the entire index.
It really speaks to the fact that it's a market that really has to be targeted. The broad-based index approach, I think, is going to have a tough go because the banks aren't participating. You know, the golds are not participating as well as they should. Energy is participating, but very specific parts of energy. So it's not the big cap names that are in the index that are participating. They're kind of rolling and giving it back. So it speaks to the fact that investors have to be very targeted here. And I think maybe what the market's telling you is we got a fourth quarter rally here, but let's not get too excited about it being a long new cycle. It may be a retracement of the losses from the summer, setting up for what may come later, which may be a little sloppier market.
You mentioned energy and some of the heavyweights not taking part. What about in Canada? It's not one that you own. Yeah. Why not?
We don't own any of the big heavy market cap producers in the Canadian market, like in Canada, Suncor, Nexi. And the reason is that these companies have not so much growth, but what they are being hurt by is the cost side of things. So if you've got rising costs, and Canada made reference to something like expecting 12% cost growth over the course of the year. Well, they don't have a lot of production growth coming necessarily. And even more important, their production is more dry gas, and what the market wants right now is liquid-rich gas. So you've seen a little bit of a lift in some of the big Canadian names, but where you have seen the lifts are in those companies that do have production growth, do have liquid-rich, do have oil, do have yield, right? So very specific characteristics. Now you think about the yield theme. You've got yield energy, you've got pipelines, you've got telcos, you've got utilities, and you look at any of those groups, that's what's working. In the U.S. market, you look at the pharmas. Pharma names, for the first time in 10 years, are behaving really, really well. So I think that the market's telling you a very clear message right now.
I'm smiling on the pharma names because we've been waiting a long time. I mean, we came into the decade thinking the drugs were going to be the leaders again, and they've been a terrible place to be. In Canada, continuing with the telecom theme, because we had Shaw, the numbers were, you know, so-so,
okay, yeah.
You know, nothing to really scream about. How do you break down the telecom sector? I mean, the big weights, Bell, you know, TELUS and Rogers, and then you get down.
And I think that certainly we own both TELUS and Bell. And again, these are names we own sort of for the first time in 10 years, like we've owned them over the last 2 years. And, you know, both of them have done a very good job at recognizing that the wireline business is a cash business, cash flow business, and they're managing that really well. It's a more profitable business in Canada, certainly, than it is in the States. And the declines are there, but they're pretty manageable, and they're squeezing cash out of that business. You know, the mobile business is going to continue to grow. It's moderating a little bit here. But it has that characteristic that people are looking for, which is some kind of predictability.
But it's interesting you mentioned that, because you said that these sectors they're holding their gains, if you will, off the lows. But it goes right to the heart of that sentiment issue. It is predictable. Oh my God, do I want to be up and down with an energy stock or a tech name? But who are the people who are investing that? Is it late in the game because they're so tired of that, and maybe I want to get to sentiment because it goes to the heart of sentiment.
I think this is a really important question because it's not lost on private investors that yield has become very attractive. I mean, it's been 10 years of disappointments on the other side. What is interesting is that when you look at the institutional investor, traditionally they had their split between fixed income and equities. And sort of a hybrid yield strategy, really not a main core strategy for them. Yet now on a fixed income portfolio for an insurance company to meet their bogey at somewhere north of 6%, almost impossible. And then so they look, well, do we want to pile it all into the equity side? And equities have been less than predictable. So I think that the institutional investor is starting to look more at sort of a hybrid income strategy, which is really great for all those private investors who are already there. So you make money being invested in things where there are new flows of capital into the group. And you're seeing it. You look at the volume in the pipes over the last week, very, very strong. But there's secular growth there.
So a hybrid income strategy, explain that to me.
Well, when I say hybrid income strategy, I mean things that pay us. So whether that's utilities and pipelines, whether it's real estate investment trusts, whether it's corporate bonds. And the Canadian corporate bond market is growing actually quite rapidly now over the last couple of years. It's strategies that allow a manager to be, or an investor to be in different camps within that sort of yield asset class without it being specifically a fixed income portfolio. Because, of course, with rates as low as they are, the big fear to the income investor is, well, what if at some point we do have rising rates? In a fixed income portfolio, very hard to fight that. We're in a hybrid income strategy. You know, these pipes can have a little bit of growth, and they do have some growth in them, so you get some yield plus a little inflation protection.
And so everything else just a trading strategy? So you look at the Magnas of the world or the CPs, which look cheap, just trade them going into earnings or out?
I think that there are some camps, like rail specifically. If you look at rail through North America is behaving really well. I think UNP is having a good day today. Kansas
CP
City
and
Southern's been pretty good.
Too.
Yeah. So that group is quite interesting. You know, the autos are quite interesting here because you did have a little backlog of demand and some inventory problems. So that group is looking more interesting. The infrastructure around the aerospace group, you know, those supporting Boeing's growth, that's an interesting group. But I would say the most important leadership theme in this market is yield right now.
Okay, so let's talk about whether that is the right strategy now for the average retail investor, because that's a question we get all the time. We're talking institutional investors. They have access to simply more information. Given your outlook on the economy, is this the right way to be thinking about the equity market, what we've just talked about, the pipes, a little bit of fixed income, but you are generating income and you're in multiple sectors?
Right. I just think that this makes tons of sense given what we sort of know is the backdrop, which is muted growth. It's hard to see how we're really wrong and too low on growth. And probably it would be defensive in the event that things turn out to be worse than we think. I think we got to a point in October where there was just tremendous negative sentiment, and a lot of negatives were built in. So I do think that this is the right strategy. I do think that in a fourth quarter rally, people really should be looking at the economically sensitive names and look to be lightening on this strength. And maybe there's another 6-7% in this rally. But really, realistically, money is going to continue to flow into these income-oriented names.
David, always great to have you in. Thanks for joining us.
Having me.
We're joined by David Burrows. He's the president of Barometer Capital.
And when we come back, we're going to turn our sights to Libya and oil, Gaddafi. We're going to speak with Amrita Sen from Barclays. She's going to bring you up to date what today's events mean.
Closed captioning of this program is brought